Focusing on the fundamentals of equity investment strategies is key to success in the CFA Level 1 exam.
Welcome to this explainer. If you're a CFA Level 1 candidate, or honestly just someone looking to build a rock-solid foundation in equity markets, you are in exactly the right place. Today, we're going to master equity investment strategies together. We are taking the core concepts straight from the CFA syllabus and breaking them down into clear, highly testable pieces. So get ready, because we're moving fast and keeping it focused. By the end of this explainer, you'll see exactly how these strategies fit together to systematically hit specific risk and return objectives. Okay, let's dive into this study guide blueprint. We'll start with a Level 1 mindset, tackle the massive active versus passive debate, break down growth and value tactics, look at a really cool case study on Apple, and finally, wrap up with some AI tools and pro tips. Section 1. Mastering the Level 1 mindset. Let's make sure our heads are in the right place for the exam. So here's the golden rule for Level 1. Conceptual clarity plus application is way more important than advanced modeling. For this exam, you really don't need to overcomplicate things with super complex quantitative math. You just need to understand why these strategies work and how investors actually apply them in the real world. We need to know the why and the how, not necessarily the deep quantitative how much. Keep that front end center as we go. Section 2, the active versus passive debate. This is a heavily tested dichotomy, so let's get into it. Let's build out a comparative framework. Think of passive strategies as steady and chill. The whole objective here is to just replicate the broader market. It assumes markets are perfectly efficient, so there's absolutely no need to try and pick individual winning stocks. This approach means low cost, low turnover, and minimal research. But then, look at active strategies. This is where the hustle is. The goal is to actually outperform the market and generate that elusive alpha. Active managers firmly believe in market inefficiencies. They use deep fundamental analysis, technical charts, or quant models to exploit them. It's totally hands-on, heavily researched, and incredibly dynamic. All right, let's put on our pop quiz master hats. Question 1. An investor constructs a portfolio that mirrors the Nifty 50 index. Is this an example of A, active strategy, B, passive strategy, or C, long/short strategy? Take a quick second to lock in your answer. And the answer is B, passive strategy. If you're tracking or mirroring an index, whether that's the Nifty 50, the S&P 500, or whatever, you are passively investing. There's literally no active stock picking happening. You're just along for the ride with the broader market. Let's serve up another one, this time focusing on the operational side of things. Which strategy is most likely to involve higher transaction costs? A, passive investing, B, active investing, or C, index replication? What does your gut tell you? If you said B, active investing, you nailed it. So the crucial point is that active management means you have to buy and sell stocks frequently to chase that alpha. That means much higher turnover. Higher turnover, stacked with the cost of paying analysts for deep research, naturally equals higher transaction costs compared to the simple buy and hold nature of an index. Section 3, growth, value, and tactics. Let's zoom in on those specific active strategies now. Within active management, you generally see people taking one of two paths. The top-down approach acts kind of like a massive macroeconomic funnel. You start by analyzing the whole global economy, then you narrow it down to the most promising sectors, and finally, you pick the best individual stocks inside those sectors. Conversely, the bottom-up approach completely flips the script. It totally ignores the macro noise. It zeroes in strictly on individual company fundamentals. Basically, if a company's financials look amazing, a bottom-up investor is buying it regardless of what the broader economy happens to be doing. Let's see if you caught that distinction. A portfolio manager selects stocks based on company-specific financial analysis without considering macroeconomic trends. Is this approach A, top-down, B, bottom-up, or C, market timing? The correct answer is B, bottom-up. You're starting right down at the foundation, the company itself. As a quick little aside, the CFA syllabus views option C, market timing, trying to predict short-term market movements, as pretty unreliable. So if you see an active manager completely ignoring the macro picture to focus on balance sheets and income statements, that is textbook bottom-up investing. And this brilliantly illustrates our final major comparison in the active space, growth versus value. Growth investing is entirely focused on the future. You're looking for companies with high earnings growth, and you're generally totally fine paying a premium for that massive future potential. Value investing? Well, that's about finding a bargain today. You are hunting for undervalued stocks, typically spotting them by their low price to earnings or price to book ratios. You're basically buying them at a discount, just waiting for the rest of the market to wake up and realize their true worth. Let's lock in your understanding of this with one more mock question. An investor buys undervalued stocks expecting a price correction. Is this A, growth strategy, B, value strategy, or C, momentum strategy? Boom. The answer is B, value strategy. Buying undervalued assets because you fully expect the market to correct the price upward is the very definition of value investing. But here's where it gets really fascinating. Textbooks love to put growth and value into rigid, separate categories, but the real world is so much more fluid. Let's look at a prime example of how these lines can blur. Section 4, Case Study on Apple Inc. Linking theories straight to the real world is absolutely the best way to retain this for the exam.
Now, what's really interesting about this timeline is how Apple was viewed back around 2016 to 2019. Believe it or not, a lot of investors saw Apple as an undervalued, mature company. It had a remarkably low PE ratio, even though it was generating absurd amounts of cash. Naturally, value investors jumped all over it. But then phase 2 hit. Apple's services revenue, stuff like iCloud, the App Store, Apple Music, it completely surged. This caused the stock price to absolutely skyrocket. Almost overnight, this steady value play transformed into an absolute multi-bagger growth story. The biggest takeaway from that case study is perfectly captured right here in this CFA quote. A stock can transition between value and growth. Market inefficiencies create opportunities for active managers. The market isn't always perfectly efficient, right? A company's identity isn't permanently locked in stone. Being able to spot a value stock right before it pivots into a massive growth phase is literally why active managers get out of bed in the morning.
Section 5. AI Tools and Pro Tips. Time to bring it all home.
Now, the CFA Level 1 exam isn't going to directly test you on how to use AI, but understanding its role is absolutely crucial for modern efficiency. Tools like Microsoft Copilot are completely changing the game out there. They let analysts process massive data sets instantly, automate the drudgery of financial statement analysis, and build out complex valuation models in a fraction of the time. Instead of an analyst manually reading through 100 companies, an AI can screen them all based on PE ratios and growth metrics in seconds. Knowing how the industry leverages this tech makes you a much sharper, more context-aware candidate. All right, let's run through this final checklist of pro tips. Number 1, focus on the core concepts, not the mathematical complexity. 2, hammer home those key comparisons. Active versus passive, growth versus value, they will show up. 3, practice question-based learning. Honestly, just grind those end-of-chapter questions. 4, link the textbook theory to reality, just like we did with Apple. 5, manage your time well. Equity questions are usually moderate difficulty, so prioritize accuracy over speed. And finally, use AI smartly to summarize your notes, but never rely on it blindly. I want to leave you with this final, somewhat provocative thought. Equity strategies in CFA Level 1 are really just about understanding human behavior, how investors think, act, and react in the markets. Once you truly grasp the logic behind whether an investor is seeking safety in a passive index or aggressively hunting for alpha through a bottom-up approach, these exam questions become so much easier to decipher. So ask yourself right now, do you grasp the logic? Master the why, and you are going to absolutely dominate this section of the exam. Thanks so much for joining me on this explainer, and happy studying.